Today, we're digging into an alternative investment that has been making serious headlines lately: platinum.
That's right. In 2025, platinum has jumped dramatically in price, surging past its recent trading range. In this video, we're going to explore what's behind the rise, its real-world uses, how it compares to gold and silver, and whether platinum deserves a spot in your portfolio.
Plus, we'll show you different ways you can invest in platinum and how it scores using the FastFire Investability Scoring System. Stick with us. This could be one of those missed opportunity moments. If you've been following commodity markets in 2025, you've probably noticed something surprising. Platinum prices are on the move. After years of lagging behind gold and even silver, platinum has broken out of its multi-year slump.
Let's look at the numbers. At the start of the year, platinum was trading for around $940 per troy ounce. As of now, it's crossed the $1,400 mark, a nearly 50% gain in just a few months. That's a massive move.
What's behind the increase? It's a classic case of supply and demand at work, and right now, supply is tight.
Nearly 70% of the world's platinum comes from South Africa. But in 2025, South African mines have been hit with a trifecta of problems: persistent power outages, labor strikes, and flooding. The result? Production is down and supply chains are strained.
On the demand side, it's a completely different story. Platinum is used in everything from catalytic converters and medical devices to hydrogen fuel cells and jewelry. And with global clean energy initiatives picking up steam, industrial demand, especially from the hydrogen economy, is quietly building.
To make things even more interesting, platinum has been in a structural deficit for several years now. That means we've been consuming more than we're producing. And this year, that imbalance is finally being reflected in the price.
So while gold tends to rise in times of economic fear and silver often rides the line between industrial and monetary use, platinum is unique. It's supply constrained, industrially critical, and until recently, underpriced.
And when a metal with real-world utility becomes scarce, that's when things get interesting for investors.
Now let's talk about what makes platinum truly valuable beyond just price charts. And that's its real-world utility. Platinum isn't just a shiny metal you put in jewelry, it's a workhorse in some of the world's most important industries. As we mentioned, one of the biggest uses is in catalytic converters. These devices sit inside your car's exhaust system and help reduce harmful emissions.
And it's not just gasoline engines. Platinum plays a huge role in the hydrogen economy. It's a key component of fuel cells that generate clean energy. As the world moves toward decarbonization, platinum demand for clean tech is expected to increase significantly.
It also has major applications in the medical field. Platinum is used in pacemakers, chemotherapy drugs, and surgical instruments. That's because it's biocompatible. It won't react with your body, and it's extremely durable. Then there's high-end electronics. Think hard drives, thermocouples, and LCD displays. Platinum's conductive and heat-resistant properties make it ideal for precision technologies.
So when you invest in platinum, you're not just betting on metal prices. You're investing in a resource that powers everything from clean air to cancer treatments to energy innovation.
That real-world demand creates a solid foundation of utility, especially during times when investor interest may be low. And that's what makes platinum such an interesting long-term play.
Now let's compare platinum to gold and silver, not just by price, but by role, demand, risk, and utility.
Start with scarcity and supply. Gold has huge above-ground reserves, which helps keep it relatively stable. Silver is more abundant, but used industrially, so supply is more dynamic. Platinum supply is more constrained. Mines are fewer, production is concentrated, and disruptions in places like South Africa have outsized effects.
On industrial demand, gold is mostly decorative or financial hedge, very little industrial usage. Silver has moderate industrial usage, solar panels, electronics, some medical. Platinum, on the other hand, has high industrial demand. That gives platinum a leg up when regulation or industrial policies favor clean tech or emissions control.
Volatility is where differences appear. Gold tends to be lower volatility, often a safe haven. Silver is more volatile because it's both industrial and investment. We saw that in 2025. Big swings upward, especially in Q2, but also periods of pullback and sensitivity to supply and policy news.
Regarding recent returns, platinum has been outperforming both in many metrics. That shows how positive supply versus demand fundamentals have recently been.
Finally, accessibility. Gold is the easiest to own. Coins, ETFs, jewelry. Silver is close behind. Platinum is more accessible than many niche alternative assets, but it still has higher premiums, fewer dealers, and sometimes higher storage or transaction costs. So how does Platinum score on the FastFire Investability Scale? Starting with return potential, we give it a C. This might seem low considering Platinum is up nearly 50% this year, but a C doesn't mean bad, it means in line with long-term stock market returns. Platinum can absolutely have big years like this one, but it also has long periods of stagnation or decline. Historically, Platinum's performance has been cyclical and heavily tied to industrial demand and supply shocks. It's not a consistently compounding asset like private equity or even certain real estate strategies. So we give it a C, good upside potential, but not reliably high year after year.
Next is risk profile, which we give a C. Platinum sits in the middle of the risk spectrum. It's more volatile than gold because its price is so tied to industrial production, but far less wild than crypto or early-stage startups. Prices can swing sharply based on mine shutdowns, labor strikes, or shifts in automotive or hydrogen tech adoption. If you can handle commodity market volatility, this level of risk may be acceptable, but it's not set it and forget it safe like gold.
Finally, accessibility. We give it a B. Platinum is more accessible than many alternatives. You can buy physical coins or bars from major bullion dealers, invest through ETFs like PPLT, or buy shares in platinum-producing miners. But compared to gold or silver, the market is smaller and sometimes less liquid, premiums over spot can be higher, and not every dealer carries a wide selection. For those reasons, it gets a B instead of an A.
Let's talk about the main ways you can get exposure to platinum. The first is direct ownership. This means buying physical platinum, bars or coins, and taking possession or having them stored for you. The benefit is simple. You own the metal outright. You can get purity, control, and in some cases, potential tax advantages. But there are trade-offs. You'll need to pay for secure storage, you'll deal with premiums over spot price when you buy, and you'll need a trusted buyer when it's time to sell.
The second way is through stocks, producers, or ETFs. This is where you invest in platinum mining companies or funds that track the price of platinum. These are easier to buy and sell, just like a stock, and you can do it right from your brokerage account. Some mining companies even pay dividends. But remember, you're also taking on company-specific risks, things like management decisions, operating costs, or dilution. And sometimes these stocks don't move in perfect lockstep with the price of platinum.
Many investors choose a mix. Some physical platinum for direct exposure, paired with ETFs or producer stocks for liquidity and convenience.
If you believe the industrial demand and supply constraints are real and long-term, direct physical ownership gives you more unfiltered exposure. But many investors also pair physical and equity exposure to balance convenience, liquidity, and growth potential. Here's what we want you to walk away knowing. Platinum in 2025 has had a strong year. Dramatic price moves driven by supply issues, industrial demand, and changing investor behavior. It has significant real utility in emissions, clean tech, jewelry, and in industry. It's not gold or silver. It has its own profile, more supply risk, more sensitivity to policy and industrial cycles.
To summarize, here's how Platinum scores on our FastFire Investability Scale. Return potential is a C, risk profile is a C, and accessibility is a B.
If Platinum sounds like a fit for your portfolio, just remember, do your due diligence. Vendor selection, storage, purity, and exit strategy all matter when dealing with physical metals.
And if you want to compare Platinum to other alternative assets, from farmland funds to angel investing, download our free guide to alternative investments at fastfirecapital.com/guide.
And don't forget to subscribe to our channel. We'll break down new alternative asset classes and score them using the FastFire Investability System. Thanks for joining us, and we'll see you next time.